Is the next panel online right now?
We are.
Okay,
Yes.
I'm gonna turn this over
Here.
to you. Is everybody unmuted? Are we good to go?
Set to
I think
go.
we're ready.
All right.
Ready.
Let me just change the slide here. Can everybody see that perfectly?
We can?
All right. I'm gonna turn it over to you. Thank you.
Great. Thanks, Michael. And welcome, everyone. Thank you for joining us for a bird's eye view of multifamily, office, retail, and hospitality post-COVID-19. I have to say I am very excited about today's topic because this has to be the first time I've ever been on a panel where every single one of the focus sectors had recently been declared dead by the media. And despite that, somehow on our prep call for this panel, all of my fellow panelists seemed particularly upbeat and even enthusiastic about the opportunities that they see ahead. So clearly they know something that the reporters don't, and we're going to dive into that today. So first, by way of introduction, I'm Crystal Anstead, Head of Capital Formation for Soundmark Partners. Soundmark is a women-owned and led commercial real estate investment firm focused on lending. Our fund got its start in 2013 as a team lift out of CBRE, the largest commercial real estate services firm in the world, where our founder, Jenna Gerstenlauer, was chief investment officer of all of the debt strategies. Our strategy at Soundmark is making small, directly originated loans to local owner-operators of properties in education, innovation, and healthcare districts where we can target low double-digit returns without the use of leverage. Just a quick logistical note before we get started. We will be taking questions from the audience and would love for this to be interactive, so please do not be shy about using that Q&A button at the bottom of your screen. And with that, I will ask our panelists to begin by introducing themselves. So Tony, let's start with you.
Sure. My name is Tony Barkin. I am the founder and CEO of Allagash Partners. Allagash Partners was created to offer investors opportunities to capitalize on the wealth of opportunities in multifamily real estate, specifically with a focus on affordable working class rental properties in secondary markets. And that includes opportunities both on a commingled multi-property fund basis, so both standard private equity real estate funds as well as qualified opportunity zone funds, and then also on single property basis with respect to primarily adaptive reuse as well as some development. So our expertise, my partners and I have over 100 years of experience in real estate focused specifically on these types of assets, generally at large companies where we are now accessing the wealth of relationships we've got across the markets to bring out non-market oriented opportunities for investors. We tend to target 15+% net returns for investors, and believe that this is actually starting to be a bit of a Goldilocks time for multifamily. Although the bar of knowing more than reporters has been set extremely low for the rest of the presentation. So I feel good about that.
I would echo that. Thank you, Tony. Peter, let's go to you next.
Good morning or afternoon, everyone. My name's Peter Foran. I'm Executive Vice President of Portfolio Management for Pinetree. Pinetree is a vertically integrated operating partner. We partner with equity sources to own and operate all retail properties. It's only open air, grocery anchored, power center, community center, neighborhood, things like that. We don't have any malls. Vertically integrating meaning we have everything in-house from property management, leasing, asset management, and portfolio management. And at Pinetree, we vary the risk spectrum depending on clients' different risk profiles and return hurdles. So we go everywhere from core plus to value add opportunistic. I would just leave everyone with this. You know, we can all talk about our respective sectors till we're blue in the face. We really want this to be about the audience and what you guys would like to hear. So please, this will be way more fun for everyone if it's interactive. So please feel free to keep questions coming and we'll address them. Thanks, Crystal.
Thanks, Pete. Agreed. Don't be shy. Joe, let's go to you next.
I am Joseph DiMatteo from JDM Capital Hospitality. We've been in business for the past 17 years. For the past 5, 6 of those, we've been pretty corely focused on the hospitality sector. And in regard to that full hospitality segment, we've integrated management, asset management for hotels, resorts, food and beverage outlets. We've been involved with over 10,000 keys since our inception, over 54 hotels, nationally mostly, some international ones in Canada and South America. We have been growing as a company in more and more specialization of only investing in transactions where we have a control position in the deals. So we are vertically integrated to look at either co-GP, partnership, asset management, pref equity investing into hospitality transactions that are select service and above. That's like the Courtyard level and above, franchised and or specialty branded or unbranded hotels are in our bailiwick of what we're trying to be able to look to do. We're growing and looking to be able to take advantage of what we see as a definite dislocation in the market, one that's become extremely complicated, requiring a deeper subject matter expertise from everything from not just managing the current expenses, but the new mandated ones, the ones that are coming up from the municipalities, coming up from unions, the franchises themselves. What is generally a fairly complicated real estate asset, because it's an asset with a full-fledged operation that continues after it opens. We see the market segment as being deeply in need of finesse and know-how. So we feel that our firm brings that to that investment type, and we look to try to be able to expand that here in the coming market ahead, despite what the current market indexes are saying.
Great. Thank you, Joe. And Ernest?
Hey, Chris, how you doing? Thank you all again. And I would echo what Peter said. The more questions from the audience, the better. We think we have all the answers. You all start asking us a lot of questions, and it proves we only know very little probably. So maybe the press is right. But no, I'm with Apex One Investment Partners. I won't go through the list of bullet points. What I will tell you, and what I think is the most important aspect of our business, is we're very, I think, center focused. We have always believed that returns to our investors start at our residents' front door. We think that if you can keep the residents happy and pleased and remember that this is their home, not just an investment, that it'll pay dividends. And I think you'll see that through the results, the returns that we've achieved for our investors. We've had 94% of our investors participate in all 3 funds. We are soon about to announce our 4th fund, which is our special situation fund, looking to take advantage or capitalize on the pricing dislocations we think are coming up in the market. We think it's a very exciting time to be in the multifamily sector. We think the trend in housing will continue to move towards renters. And we're excited to be a part of that and excited to be a part of this panel today.
Perfect. Well, thank you, Ernest. We're certainly excited to have you with us. And I want to stay with you a moment longer and start on the multifamily side of this panel discussion. So today is June 24th. It's now been just over 100 days since the World Health Organization declared COVID-19 officially a pandemic. What's changed in the multifamily sector since then?
Well, I don't know if a lot of change if a lot has changed. I think we're learning some things. A few changes I will note, though, and maybe we can talk about these later as well. We're certainly seeing a broader use of technology in our sector, especially when it comes to working with tenants and residents. We're seeing them use the technology more for leasing and lease renewals. One of the other things that we've seen is our renewal activity has actually picked up. Notices to vacate are down. And I think that's just a reflection of people wanting to stay put during uncertain times. We are also, interesting enough, we're also in the student housing sector. And in the last couple of weeks, we've seen a surge in student housing leasing activity. Some of the numbers are staggering in terms of how active those leasing parameters are. And that's obviously due to, one, the schools announcing that they will be holding classes during the fall, at least the schools where we have properties. And second, the change in the way the dorm density is being looked at. The doubles and triples seem to be out. One person to a room is the rule of thumb, and that's pushing more of the students into off-campus housing as well. So, there's been some challenges, but we're hanging tough, and our residents are hanging tough with us.
No, that's great to hear. We've certainly seen the same on the technology front as well with our properties. And for us, one of the things that we've observed, speaking of technology, is the focus on how building design can contribute to health, and an increasing focus on some of the third-party certifications like LEED or WELL, which are not just about energy efficiency, as you know, but about things like air circulation and making sure that the proper air filters are used so that we can keep people healthy. Maybe staying on the topic of multifamily for a moment more, Tony, we can go to you. And I noticed an interesting and scary data point on your website that the average vintage of affordable workforce housing is in the 1970s, and that over the last 20 years, for every new unit of affordable housing built, 2 units have been lost due to age or neglect. I'm curious, what are you seeing as a result of COVID-19? Do you think that will exacerbate this trend, or are you seeing an opportunity perhaps to invigorate workforce housing?
Well, I think that unfortunately, the trend is continuing, mostly, in fact, from a lack of capital from the sector. And I don't think that certainly COVID-19 and just moderately slowing capital flows across the board in every sector, not just real estate, not just multifamily within real estate, but within every sector, is going to help that. But the reason for the occurrence of this shortage has been primarily a lack of capital flowing into workforce housing and working class housing. There's been, and when I say capital, I'm not talking necessarily about the development of subsidized housing, which can be done economically, or the development of higher end socioeconomic housing, but really kind of what we'd think of as the working class, middle class housing, which represents about 45% of the households across the country. There's really been very little capital flowing in either for the purchase of those properties or for the building of new properties, for which there really isn't a profitable development paradigm right now. You can build to sell, but it's very difficult to build working class housing to rent currently. And so I think that those things are probably, that capital flow is probably going to be slightly exacerbated. That being said, it does open up some very significant opportunities for both capital investment in terms of just scalability, as well as for returns. Because there's been such a dearth of capital in these areas, you've got the opportunity now to go in and buy properties, existing properties, at really dramatic discounts to ground up development costs, as much as 80% discount to ground up development. Now that requires significant subsequent capital investment in the property. But even after what we call deep value add at the property, you're still at somewhere around 40 to 50% discount to ground up development, which means that you can bring those properties back at an affordable level for the working class population that exists in the community. And you don't have to build or develop or be adding value and capital, expecting some change in the demographic of the community. So it's not a gentrification trade. It doesn't have to be. You can create mid-teens or higher net returns based simply upon the existing economics of the communities. Really starting with the most important part, which is being able to buy extremely opportunistically.
All right, thank you, Tony. And certainly another headline that we're seeing is that one of the impacts of COVID-19 is the depletion of savings, meaning that it's going to be even longer before people that might have been actual home buyers will be able to do that. And so the importance of being able to rent, whether it's in affordable housing, existing construction or new development, it's just the demand we're seeing is just going to increase for multifamily. Joe, I want to go to you and focus on hospitality for a second. Also one that's certainly been in the bullseye of the media, and not without reason. I mean, certainly at the depths of this crisis, hotel occupancy was down as much as 90%, RevPAR over 80%. But you made an interesting point on our prep call, how the challenges for hospitality are changing daily, but you're also seeing opportunities. So can you tell us a little bit about the green shoots that you're seeing?
Sure. So first off, the opportunities, the problems that are out there are pretty prevalent, right? You've got a worldwide epidemic, obviously pandemic, that you have international travel slowing and ceasing in multiple markets that are normally draw markets. So you have an increase in domestic travel that's a drive market, which is a differentiating factor for certain assets. So I think that that's going to be something that's going to be in queue for more than a short period of time. So with that, you have individual municipalities that are looking for solutions, mandating solutions without process or standard operating procedures, and people and from those channels of municipalities and franchises and current owners really not having a clear path of what to do. So the standardizing of those processes, but the current moment of inefficiency is where we see certain underlying constants. One is that we see that for the medium and longer term, larger assets are going to have a greater difficulty in the marketplace, and that was already changing, and this is accelerating that change. You go historically from 50 years ago of the Waldorf Astorias and Plaza hotels of 800-900 keys down to the world of 500 keys, and then shrinking from there, where we were probably settling at a 250 to 300 key property as being, in my opinion, optimal. That I think that there's going to be a shift and change in cost structure. It's going to cost more to operate these hotels. It's going to also cost more to be able to service the demands of both municipal unions and franchises. And you're going to have an increase in costs because of that, and a greater demand on revenue. So you're going to have a certain circumstance where these 500 plus and maybe 350 plus key hotels are just not going to be able to make that curve. So there may be an opportunity for redevelopment of those assets. We see that as an opportunity, whether those assets are going to be partially rezoned into condos or multifamily uses, mixed uses, and smaller hotel needs within those existing properties. And we're going to see smaller hotels and medium-sized hotels, which aren't going to have a larger dependency on the group business. I think that for the very near term into the medium term, you're going to see people hesitating walking into, a 500 or 1,000, person event with the same confidence that you did, 6 months or a year ago. So the opportunities we see are perfecting more of that smaller high-end boutique experience. That's why we're, as a firm, even before any of this happened, we're very focused on that select service and above, and looking at that 75 to call it 225, 250 key aspect of where that is going to be, where that's going to sit in the high and low for us, of what we're going to be able to deliver a consistent experience, control the environment, make it a profitable undertaking, and be able to turn those assets into problems into opportunities. And those problems and opportunities will sit in both opportunistic and value-added opportunities. So our forward strategy is going to be 50% into an opportunistic scenario of redevelopment and heavy development and redefining, like you said, in regard to whether it's what may come from leads or wells, in regard to what's going to be qualified as a healthy environment, and then the value-add approach of where you're taking maybe 350 keys down to 200 keys and making that a new profitable venture, depending upon what's going to happen. And that value-add approach for us. Sorry.
Oh, sorry, I didn't mean to cut you off. I just wanted to jump in because we are getting some questions, and you started to touch on this, but I just wanted to ask the question specifically. So we have a question from the audience asking, what are you seeing now with respect to new construction? You touched a bit on redesign, redevelopment, but what do you see is going on with new construction?
Sure. So from the new construction side, I think that you have trouble issues, right? You've got, number one, your construction costs are going to go up because you have to plan for different changes in regard to the flow of traffic, whether that's your placement of your reception and how people are going to be staged, to where you're going to store luggage, to how many people, what's going to be the elevator demands that may come out. So people going to get people who are going to go get new zoning or need new extensions on their zoning may fall into a surprise where they thought they had certain things that are as of right and they need to extend certain permits. Those extensions may not be as easily granted as they were before. So increased cost, increased amount of time. And I think that the planning and timing in regard to those things are going to have a little bit more of a finesse. So that's definitely a big picture. I think that the opportunity in new development is planning for that, all of these things that are happening. If you're not deeply into the design, but you've got a great location, I think that that's going to be a tremendous opportunity. I'll leave you with the last thought on that, that it's going to be something that's outside of every CBD market. Things that may not have been normally thought of, that has to be dead center 57th and 5th in Manhattan, may not be your optimal place to build your next asset.
Oh, it's very interesting. Thank you, Joe. It's very helpful. And Peter, I want to get to you. We have two questions for you. The first is starting off high level. Even before all of this COVID started, it felt like brick and mortar retail was being declared every day. They might have even called it already, but yet it still seems to be alive. And I'd love to hear from you, a little bit more about what you're seeing and what's the right way to think about it. You made an interesting point that you get asked on a daily basis, multiple times a day, what are rent collections? What are rent collections? But how that might not be the right way to think about it. So how do you take the pulse of retail?
Thanks, Crystal. I think it's a fantastic time to be in retail, actually, and many people will call me crazy for saying that. But I think opportunities come from change. And when things are stagnant, that's when work is boring, lives are boring, and there's no opportunity to capitalize on that. When things are changing and markets are dynamic, that allows people to take advantage of market pricing, dislocations between buyers and sellers or tenants and landlords. And that is definitely happening in the retail sector right now. I think it's also important to delineate retail for a long time has been just sort of lumped in as one category. And where I see opportunities in the retail space is not all the malls, not enclosed malls with a food court and Sears and JCPenney, but in open air centers where people can drive up, get out of their car. They still cross shop between different tenants, but you're no longer going to a vast mall. Those are definitely overbuilt in the United States. And we see that reflected in market pricing for those companies' stocks, as well as in asset pricing for malls themselves. So on the good side of retail, we still saw through a pandemic, grocery stores continue to do sales volumes that frankly have never before seen. Some of our grocers were doing volumes like every week was the week of Christmas. And those sales skyrocketed during this pandemic. Pharmacies, dollar stores, pet stores continue to do well. Best Buy did a ton of business during this time. It was done differently. They found ways to change their business model to move more online, offer curbside pickup, and we as landlords were obviously conducive to that and trying to find ways to help now, including get restaurants outdoor seating and things like that. To kick off this event, Prequin was talking about reasons that people invest in real estate, and I think many of these continue to be true in the retail sector. Yield is one, reliable income, and a hedge against inflation were the 3 points made. And when you look at retail right now, its cap rate spread over a 10-year treasury are the highest they've been in recent years. Retail cap rates compared to other real estate sectors continue to look favorable. And I think that's where it becomes critical to be buying the right retail, because the other side of the coin is reliable income. And when you have large portfolios anchored by grocery stores, all the grocery stores have continued to pay rent. Those are counter-cyclical and have low correlation with other sectors. We see Albertsons coming out with an IPO. That'll be good for the retail sector. We see companies like Amazon making bricks and mortar acquisitions, whether it be Whole Foods or other companies, including making retail somewhat of a hybrid storefront for consumers to shop at, and then small kind of last mile distribution out of the back. These neighborhood centers are close to where people live, and they still provide things for families to do. And then the last point made was a hedge against inflation. And one unique thing about retail is that your expenses are recovered by the tenants. So to the extent you have expense inflation, that gets passed through the common area maintenance costs and real estate taxes. You also have 5-year or 10-year leases that roll, so you can mark to market those rents over time. Should there be inflation, you're not coming out of something with in terms of real dollars, negative cash flow. But I think the rent collections is interesting because I get asked it all the time, and we do see people starting to pay back. Our collections are around 70% for April, and it drops to about 60% for May and June. But the reason I think that that's frankly just not really that important is I'll use Sears as an example, because they've been kind of the poster child for this. Who really cares if Sears pays rent in April, May, or June? The real question is, are they going to make it in the long term? Mm-hmm. And I think that's why the rent collections don't necessarily matter. It's critical to have the pulse of your tenants, to work with them to get through the times, so that your strong tenants pre-COVID continue to be your strong tenants in a post-COVID world. And then I think just, again, with retail, you have to be in active asset management. I've heard that on a number of these presentations as well. You can't just sit back and collect a coupon clipper rent check. You can actively asset manage retail properties to better performance.
We completely agree. And we also have in-house asset management at Soundmark, and it's never been a more important time to have that direct line of communication with your renters, your borrowers, your owners. It's just crucial. Ernest, I want to get to more of the Q&A and bring you back in here. We have a question. Will multifamily prices see significant declines in large cities by the end of 2020? What are your thoughts there?
Well, there's two thoughts. I think it's a tale of two cities, or in this instance, a tale of two owners. I think the owners that have long-term patient equity, especially in the large cities, can probably sustain through this and hold on to see what the outcome is at the, during and after the recovery period. I think that owners that are maybe at the end of their fund life, or maybe they have a single asset investment, or maybe they're in a market that's impacted dramatically, they may be forced to sell, which could lend itself to discounting, and that's the pricing dislocation. Let's face it, rents were just astronomically high in a lot of cities, especially San Francisco, New York. And there are the places that, while we're seeing the high 90 rent collections nationwide, if you pull out those cities, for instance, I heard in Orange County and San Diego, rent collections in multifamily, the higher end multifamily was only 75% the last couple of months. So I think you will see some good buys if you want to go there in those larger cities. I don't know if it'll be by the end of 2020, given the forbearance. And I think also given the protection that a lot of these owners have in courts, the amount of time it's going to take to get into courts, since a lot of the courts are closed and they may have other issues to deal with. So I don't think the big buys are going to come late in 2020. I think they'll push over into next year.
Great. And Tony, did you have anything from your perspective?
Yeah, actually, I mean, we focus primarily on secondary markets, which we define as metropolitan areas with 250,000 to 2.5 million people. And I actually think about it, and I was thinking a little bit about something that that Peter had said earlier about inflation, and also the comment I'd made earlier about the Goldilocks period for multifamily, which is that if you flip the question you asked on your head about will the larger markets see rent reductions and income reductions, I think the question could be asked over the long term, which is where can you see rental growth if in fact you've got inflation picking up in the economy? So if this period turns out to be different than the last period, so now we've got very, very hyper low interest rates again. Last time that didn't lead to inflation, but if it does lead to inflation this time, where could you see the opportunity for rent growth? And I think that the answer to that is actually in the secondary markets. So I think that if you start to think about not only, what's the risk as a result of COVID, but where are opportunities being created as a result of COVID over especially kind of an intermediate and longer term, I think that in the secondary markets where rents have been lower and where you've seen low wage, really the effects of low wage growth, this time could be dramatically different. I think personally that we're going to see a significant round of inflation out 3, 4, 5 years as a result of this, because I think that we're going to get past this COVID period. And I think that the government is on a low inflation drug cocktail that they're not going to be able to get off in time. And I think that when you think about where is the opportunity, multifamily is a great opportunity because it allows a reset of rents more quickly than most of the other classes. And so it can keep up with inflation. And I think that when you look at the secondary markets, if there's going to be inflation in wages as a result of this, which I think we could also probably expect, then we're going to see rental increases as well. And I think that's going to be very positive for those areas.
That's a great point. I love staying with the positivity. I do want to address the other question that we have, though. This is to the group. How will you navigate if the second wave of the virus materializes? So maybe, Peter, we can go back to you to start there.
Yeah, sure. First of all, I hope that doesn't happen. I think all of us would agree with that.
Agreed.
For our own sanity as well as our businesses and our investments. In the retail sector, this has been a great trial period. So if it does come back, I think we'll continue to see, I think regardless of whether it comes back, we'll continue to see curbside pickup delivery being offered by tenants who had previously not been able to offer that. I think if anything, we'll see more of that. Certainly if it comes back, that will increase with dedicated drive lanes. Target was one who took a bunch of parking spots and made them pick up only parking spots. I think we'll continue to see that, some directional traffic flow to move cars individually through the center, get what they need, and stay distanced from each other. And then I think on the capital markets side is really where we would need to see relaxation of regulatory requirements on banks and how much of their debt is in default. There are a lot of landlords right now who can still make rent payments, but may not be able to meet compliance because of the way certain debt yields are calculated or things like that. So on paper, you might be in default, even though you're making your debt service payments.
Right. And Joe, this is, I'm sure, something that you are thinking about and also equally, hoping does not materialize. So how do you see a second wave impacting your sector?
I think it's well, there's two things. The one school of thought is if it's going to happen, let it happen quickly. So the idea is that if you're getting to a point where you've got the maximized amount of tests that are out there, the math is pretty skewed all over the place. But the idea is that if you've got the maximum amount of tests that are out there, and then you've got an ability to really measure what that means, I think that that measurement will make that difference. But it's like a deal, right? The worst thing in the world is a slow no, right? So the idea is that if the impact is going to happen, it's going to show mathematically better in a shorter period of time. And I see this, as from a business perspective, not from, only from that side, not from an opportunistic point of view. I think that as a macro piece, the faster we can get past this, by one way or another, is going to be better for everybody and beneficial for the worldwide economy. Because I completely agree with the inflationary factors, which I even touched on earlier when I was saying that the room rates are going to have to go up to cover the costs and expenses that are going to be required that are going to stay with us for a while. New York alone just recently had a union change that basically created an entirely new department within the cleaning department. And the union changes are after a guest is there, that a room cleaner does not have to go in there for 48 hours afterwards, that the cycling of how that's going to be done, and like a preventative department that has to exist in regard to suffice the unions, some of which are all good, but they are going to drive up those expenses. So a second wave is either going to stringently, more nationally, create more choppiness in regard to how you do business in city or state A and city and state B, is what you're worried about. Those costs and those expenses will drive up even higher, quicker, faster, causing more and more drops in occupancy, not only from a fact of demand, but by the mere fact of being able to be capable to suffice the demand that wants to come in. If you have 100 keys and you're only allowed to utilize 50 of them basically every 48 hours if you don't have a longer term stay, that's fairly impactful, and that's going to drive up the costs of shorter term and definitely increase longer term needs. So it's going to be very, very, and I think definitely it's going to have a major impact on the Airbnb world, which is fake management, in my opinion. This goes back to the need for subject matter expertise and hands-on management. All they are is a marketing machine with and without the ability to see day-to-day controls of what's happening in any of the properties. And that's going to be a definitive hole in the side of the ship that will drive back the need for more professional hospitality management, drive back the need for more standard of care, drive back the need for people to and brands to have a process and an implementation to stand behind.
Right. Sounds like you're saying hospitality is not for tourists. You definitely need to have some firmly entrenched expertise in that sector.
No toe in the water in this industry.
Exactly. No. Oh, great points. Maybe taking a step back and getting back to something that Peter had started to mention before, with respect to, will Sears be around tomorrow? Is that really the right question? Are they going to be around for the long game? I'd love to get the panel's thoughts, looking beyond the fall, looking a year out, or even asking the question, what is the right time horizon now? With so many changes afoot, as you're thinking about new investments, what's the time horizon that you're thinking of? And maybe Ernest and then Tony, we can get you back in here.
Yeah, this is Ernest. We've continued to acquire. We closed on a property in May. We certainly are changing our underwriting criteria. We're fortunate that we're one of a handful of select sponsors by Freddie Mac. We have the same underwriting team assigned to us, so we can still move fairly quickly. We've got a lot of dry powder to close on deals. So, we continue to look for properties. We're seeing them both come out on market and off market deals. So, we haven't stopped looking, but how we underwrite them has changed considerably. And I expect there will be a wave of new deals coming out the first of the year. A lot of owners, including ourselves, who have some properties to sell are just sort of, trying to push past the expected price discount. And I think we'll see a significant number of properties in the multifamily sector coming out first quarter of 2021.
Yeah, this is Tony. I agree with Ernest. I think that in our sector, I think they're not, the volume has dropped significantly over the last few months, but it hasn't dried up. And we're in process right now of going to contract on 2 more properties. Our last close was in March. And we're planning on continuing to grow the portfolio. I think it's a little bit different in multifamily for 2 reasons. One of which is that while there are operational changes that need to be addressed, you need to be able to understand how you're going to renovate properties, how building is going to work. Can you go in safely with crews while you've got tenants occupying? How are you going to turn over property rooms and units as you get them? The challenges, I think, are different than they are for the other real estate sectors, which really have to pretty dramatically change operations. The risk that we found, which I think is one of the things that Ernest talked about, the things we've learned at the very beginning when he was answering your first question, Crystal. One of the things we've learned is that we really can rent properties using technology, and that we are not really seeing a significant drop-off. We are seeing a significant drop-off in notices to vacate, but we're not seeing for the vacant property, for the vacant units, we're not seeing a drop-off in rental activity, which I think from our end is both a learning experience and a very positive aspect. So we feel that it makes a lot of sense to continue to go ahead where we see value and to continue to make investments. And I don't see that really changing for multifamily. I think that, with all of this that goes on, the supply goes up and down as people are willing to transact, but the demand at the bottom line remains constant, and there's a shortage. And so, I think our short-term, intermediate-term, and long-term dynamic remains very positive.
That's a great point. I mean, the shortage is something that is a very real dynamic and probably underreported in the news, and perhaps even some confusing headlines about, oh, well, with COVID, that must mean that people aren't going to want to live in multifamily housing type developments anymore. It's just going to be single family homes. But speaking as you did to the demand that you're seeing, it's definitely not the case, and not expected to be the case for some time, just given what we touched on earlier with both the affordability and the different reasons why people go to multifamily. So it's great color.
Yeah, I think we forget that the American dream just used to be having a roof over your head. And that got changed by the mortgage industry primarily to owning your own home. And it would be great if every American could own their own home, but we just don't have the infrastructure for that. And multifamily in its various forms still remains the primary method for people to put a roof over their head. And I think that's going to continue. And in fact, that roof over your head and that ability to have private space is only more important going forward.
Exactly. Pete, maybe we can bring you back in here thinking about the time horizon. Since you raised the topic, what do you think is the right time horizon when you're thinking about the different facets of retail?
Yeah, I was actually talking to the guy who heads up our acquisitions yesterday about this, and we were discussing opportunities in the market. I think for retail, it will be really towards the fourth quarter of this year or next year. It's going to take some time for people to understand how to underwrite tenants, given the COVID issues, and who will survive and who will not. Secondly, in order to have a transaction, you've got to have meeting of the minds between buyer and seller. And I think that that's going to be particularly tough when you have tenants who on paper are paying rent, but it becomes more challenging to underwrite the reliability of that rent and releasing costs should they vacate. So I think the rest of 2020 will be a lot of learning for both buyers and sellers. And then I think 2021 we'll see a lot of deal activity. Capital markets still remain strong for what I was calling the right retail. All the banks I've talked to continue to tell us that they will lend on retail centers with good rent rolls, stable rent rolls. So I think you need buyers and sellers, and you need the debt markets to stay where they're at.
Great points. And Joe, staying with time horizon, I'd love to get your thoughts on time horizon for recovery in hospitality. When you think about how, as we touched on before, in April and May, occupancy levels dipped down, dropped almost 90%. And when you think about how even after 9/11 or in the global financial crisis, they bottomed out in the 70s. So not dropping 70%, but achieving 70% occupancy. Looking at levels below 10% now, what do you think is realistic in terms of recovery? And, is that even the right focus? Is that the right way to think about it from an occupancy?
So I guess I got to answer the question slightly differently. From an investment point of view, are you asking from an operational point of view? From an investment point of view,
Investment.
it's a value play. This is where you're going to look at it of replacement value to acquisition cost. You're looking at it from a point of view to say, this hotel was previously built for $500,000 to $700,000 a key, and it can be, you can leverage a position in or go and have an exposure of $350,000 a key, which is below replacement cost at the same point, enough for you to be able to capitalize repositioning it and be below any of that. So I think it bodes well for an operator and a person who's a hotelier like we are, to be able to leverage those pieces and figure out how to drill down, because the hotel business is very different than residential, commercial, retail. It's pennies make nickels, make dollars. So it's you save this much money on where you buy your spoons, and it impacts your overall net cash flow expense. You go out and you put LED lighting in, it impacts all real estate investment, but when you have the ability to shut lights off when people aren't there, when you're paying the bill for the whole building, it's a different impact to the bottom line. So the value play of where you're looking at things and where you're underwriting to what you would see 2019 being the benchmark, I think is where the thrust is. So you're looking at now the second point is in regard to operations. You're looking at 2019 as the threshold year and saying backwards from there, what does it take to get to that? What is it going to take me to do X, Y, and Z to bring it close to, back to, or stabilize within a range of 2019? I think that's the safest way to kind of look at things from where you see a robust economy that has international travelers, has people moving about in a safe manner, but still reflective of changes that happened in group business, where the group business had already started on the 3-year kind of path of already dropping itself off in regard to what was, a normalized, event size. So I think that 19 is probably the benchmark concept, and what you do to get there is what you need to understand operationally. And then second, just to reiterate, it's a value play. How much can I get it per key? What's my price per pound? And do I feel good about that? And having to reinvest money above that to making sure I could stabilize out to a cash flow that'll bring me within that range.
That's great perspective. Thank you. And then maybe you're switching over to underwriting. So we talked about time horizons for new investments and how to think about that. But it'd be great to hear from the group how you're thinking about sourcing and then underwriting new opportunities. So maybe Ernest, your firm is about to launch a new fund. No better sign of optimism about the opportunity set than that. How are you thinking about sourcing and underwriting new opportunities amidst all the new dynamics at play today?
Yeah, well, we follow a lot of economic advisors, and a quick plug for our friends at Witten Advisors that has great information on the multifamily sector. We're basically underwriting, when all is said and done, we're bringing our occupancy down to about 88% on new underwritings, and that's pretty dramatic. We also are looking at flat to negative rent growth through 2022-ish or so. We are seeing better interest rates, but probably assuming more equity into those transactions. I don't think we're going to get there in the market. Tony's probably rolling his eyes at me. I don't think we're going to get to those places, but we're certainly using that as a base case and then build up from there. So we're not predicting the collapse of multifamily, but we think there's a lot of sellers out there that may have to sell. And some of the markets we're looking at have been impacted dramatically by COVID-19, but we know they're good, strong, recovering markets. And so we're just preparing to hold on during a tough time. One of my investors who we talked to the other day, we were discussing the differences in underwriting, very, very smart investor. And he made the analogy, says, in the past, when you've done underwriting, you go in with a big capital deployment for common areas, the units, just to really do some deep value add on these units. Now what you're doing is you're going in with cash to hold them through the potential downturn. So that's some of the ways we're underwriting, and I'd be glad to hear what others have to say. Thanks.
Tony, what say you?
Yeah.
Were you rolling your eyes?
I was not rolling my eyes. I actually agree in some respects. I think from, certainly in the areas that we're looking at, I think that we're already running our occupancies in the low 90s, and always stressed down to the mid 80s for any property with respect to cash flows. And a lot of that is because we are doing deep value add. And so in the properties we look at, as we do that, we use the natural turnover at the property in order to renovate in unit. And so we wind up actually taking our properties down in terms of occupancy during the process. So our process is one where we have to stress down to those types of levels because the properties do see that type of occupancy, certainly for at least short periods of time. I'm not sure that we're going to get, as again, I agree with her, I don't think we're going to get there in terms of the marketplace, because I think that certainly in the areas that we're looking at, which are really, middle class, working class areas, people aren't sitting around thinking about whether they're moving to the suburbs. It's just not their thought process. I think that is a risk in New York and in San Francisco and in some areas where you may have, a significant chunk of the population who's paying, quite high rents, thinking to themselves that they would be better off in this environment moving out to the suburbs. But I don't think we're going to see that in the areas that we're looking at, which are really the peri-urban areas outside of secondary markets like Richmond and Norfolk. The people there are pretty well set in their multifamily lifestyle, and the rents are affordable to them currently, and that's what they care about. So I don't think we're going to see any type of repricing there. I do think that you're going to see, you've got to be cognizant of the fact that we've proven that rental works right now. But, if this goes on for 2 years, I think we're already effectively beginning the second wave, quite honestly, nationwide. I think that if you look at the graphs, it's really the effect of New York having gone down that makes it look like it's not already a second wave. But I think we're there. And so I think we've got 6 more months of dealing with this at least. But I think if it goes for much longer, if it goes for a year or 2 years, then I think that everybody's going to have to readjust to some extent.
Okay, well, we are just about out of time, and I'd love to end on a high note. So if my panelists will indulge me, I would love to do a lightning round before we go. 1-word answers. What is the best thing to come out of COVID-19 for your sector? And Pete, maybe we'll go Pete first.
Innovation.
Tony?
I'm going to use a lot of dashes. Working from home.
Ernest?
Stimulus check. I'm just kidding. Demand.
And Joe?
Expertise.
Excellent. Certainly needed. Great. Well, thank you so much, my panelists. This has been a really engaging, interesting discussion. I thank you all for your insights and encourage anyone whose questions we did not cover or didn't get a chance to submit them. Please don't be afraid to use that button. We'll be happy to circle up with you offline.
Crystal, thank you so much. Thank you to all the panelists for the conversation today. It was enlightening. It was sobering, and there's definitely light at the end of this tunnel. So we appreciate everything that you all discussed today, and we look forward to having you all back and involved and continuing to follow the unfolding in your various spaces and expertise. So we appreciate it. Thank you very much.